Hello, this is Japanese Economic Review Channel. Welcome to the market briefing for March 12, 2026. Today we examine the chain reaction of energy, focusing on how a surge in commodity prices has triggered a global macro rotation. Our analysis moves beyond simple price action to explore the systemic links between energy supply, inflation, and the diverging monetary policies of the US and Japan. The market faced a brutal session today. The Nikkei 225 plummeted by 572 yen to close at 54,452, marking its third consecutive day of losses. This triple threat was driven by an energy shock, a contraction in the US tech sector, and intense caution regarding the impending Bank of Japan policy meeting. Global sentiment has shifted from optimism to a defensive wait-and-see posture. The primary catalyst is a fundamental shift in the inflation narrative. The IEA's warning of an April supply shortage pushed WTI crude to $95 per barrel. Simultaneously, US CPI halted at 2.5% YoY, defying hopes for rapid disinflation. This energy inflation nexus has effectively removed the safety net for highly valued equities by disrupting the expected interest rate timeline. On Wall Street, the 2.5% CPI reading acted as a gravity well for tech valuations. As hopes for near-term rate cuts evaporated, capital fled heavily weighted tech names and the Magnificent Seven. This led to a sell-off in giants like Micron Technology, Intel, and Tesla, dragging both the Dow and Nasdaq into their third day of losses. We are seeing a unique convergence of different pressures. While the US is reeling from supply shock inflation and aggressive repricing of Fed rate cut timelines, Japan is paralyzed by anticipation of the BOJ monetary policy meeting. The result is a mutual sell-off. US tech weakness is spilling over into Tokyo, while foreign capital engages in aggressive profit-taking. The Nikkei's intraday movement was dramatic. After tracking US losses in the morning, a wave of futures-led panic selling at 1:35 p.m. JST sent the index to a daily low of 53,796 yen, a staggering 1,229 yen drop. However, sheer valuation floors triggered late-afternoon dip buying, allowing for a modest recovery before the close. This volatility signals a market searching for a bottom. The sheer scale of today's decline is remarkable. Over 93% of the prime market collapsed, with 1,473 decliners against only 105 advancers. This indicates a systemic decimation, where investors found almost no place to hide. The lack of localized buyers meant that nearly every sector was swept up in the global contagion and BOJ apprehension. Today was a study in extreme sector rotation. Out of 33 industry sectors, only 3 survived the carnage: mining, oil and coal, and electric power and gas. The 30 casualties included rate-sensitive sectors like real estate and securities, capital-intensive industries like logistics, and export-driven tech and consumer goods, all hit by the combined weight of rising costs and yen fluctuations. Why did these 3 sectors defy gravity? Mining companies like INPEX and K&O Energy were driven directly by the crude oil surge. Oil and coal products benefited from anticipated upward pricing power due to IEA supply constraints. Meanwhile, defensive utilities like TEPCO and Kansai Electric acted as safe havens amidst the broader market panic, pivoting upward as investors sought stability. Conversely, rate-sensitive sectors were the primary anchors dragging the market down. Real estate giants like Mitsui Fudosan and Mitsubishi Estate suffered on fears of rising borrowing costs. Securities firms like Nomura were punished in anticipation of dropping market volumes. Even the previously strong insurance and logistics sectors faced severe profit-taking as investors moved to liquidate positions. Risk appetite has vanished from the growth market. The growth market 250 index suffered sharp declines, with recent high-profile listings like Time, Cover, and Genda facing severe downward pressure. Most notably, Panacea 485A hit its lower limit, S-Yasu, amidst retail panic. This flight from growth confirms that liquidity is rushing toward defensive energy havens. Despite the macro turmoil, corporate innovation continues. Yamaha launched its Creator Pass, and JR East deployed AI-driven pantograph monitoring. Honda is advancing solid-state battery production, while Macnica launched new AI robots. These strategic moves highlight a micro-catalyst layer, where individual companies are attempting to build long-term value despite the temporary macro headwinds. In conclusion, the March 12th sell-off was not a random event but a highly correlated, energy-driven macro rotation. The chain reaction from commodity shocks to BOJ anxiety has tethered the Nikkei to US inflation data and global volatility. Until the Bank of Japan provides clear policy guidance, We expect this high volatility environment to persist across all asset classes. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.